Welcome to Cotality's Housing Market Update for June 2026. Brought to you by onthehouse.com.au. The Australian housing market has continued to lose momentum, with Cotality's National Home Value Index stalling with a 0% change in May. Sydney and Melbourne are leading the market into a downturn, with values down 0.9% and 0.8% over the month to be 2.1% and 3.2% below their record highs. Canberra was also slightly lower over the month. At the other end of the spectrum, Perth and Darwin continue to post the strongest monthly gains, while values in Brisbane, Hobart and Adelaide were still rising, although growth rates are slowing. This multi-speed pattern has been a defining feature of the housing market for several years now. Over the past 5 years, Perth housing values have surged more than 90%, while Melbourne values are only modestly higher over the same period, up just 3.3%. But even though the pace of change still varies from city to city, the overall direction is becoming more consistent. Most markets are now losing momentum as demand-side pressures build. Importantly, the slowdown was already taking shape before interest rates started to rise, before renewed geopolitical uncertainty, and before housing tax changes were announced in the federal budget. Amidst all that, affordability and borrowing constraints have been weighing on housing demand for some time as well. We're also continuing to see an outperformance across the lower price points of the market, although these segments are also losing momentum or even recording declines in some cities. In fact, some of the more affordable segments in Sydney, Melbourne and Canberra are now recording falls as well, which shows how broadly the slowdown is spreading. However, the higher priced tiers of the marketplace remain the weakest segment in terms of value changes. Alongside weaker value growth, housing demand is also showing up in lower sales activity. Our estimate of national home sales over the past 3 months were down 2.2% on a year ago and below the 5-year average. The biggest drop in sales has been in Sydney and Melbourne, where listings have also risen above average levels. That's giving buyers more choice and a bit more negotiating power. Selling conditions have softened as well. Auction clearance rates have been hovering around 50% across the capitals, and advertised supply is trending higher in most markets. Regional markets are holding up better than the capitals, with housing values rising 0.6% in May, compared with a 0.1% fall across the combined capitals. Despite the gains, the monthly rise was the smallest in a year, so the slowdown is becoming more evident across regional markets as well. Regional Western Australia continues to lead the way, while regional New South Wales recorded the smallest monthly rise. In the rental market, rents rose another 0.6% in May. That takes annual rental growth to 5.9%, which is the strongest annual pace since September 2024. The main reason rents are still rising is that vacancy rates remain extremely low. National rental vacancy reduced to 1.5% in May, which is back in line with the record lows we saw during the migration surge. The big question is, how much longer can rental growth keep running at this pace? Renters are already devoting around a third of their gross incomes to housing costs, and rents are up roughly $204 a week over the past 5 years. That may mean we start to see more structural changes in rental demand, including larger household sizes, more shared living, and more multi-generational households. With rents continuing to rise, while value growth slows, rental yields are edging higher. Across the combined capitals, the gross rental yield is now 3.45%. That's the highest since the middle of last year. Melbourne continues to record the highest gross yields amongst the major capitals. But even so, positively geared investment properties are still likely to be rare, given investor mortgage rates remain well above rental yields and holding costs have continued to rise. Melbourne housing values fell by 0.8% in May, taking the market 2.9% below its cyclical peak in November last year and 3.2% below the record highs reached in March of 2022. The more expensive sectors of the market have been the weakest, with house values down 3.3% over the first 5 months of the year, compared with a 1.4% fall in unit values. Similarly, upper quartile housing values have borne the brunt of the weakness, with upper quartile house values down 1.3% in May and upper quartile unit values 0.8% lower. Demand-side headwinds are also evident in lower sales activity, with estimates for the 3 months to April tracking 14% below a year ago. Looking ahead, the balance of risks across the housing market is tilting further towards weaker demand and lower turnover, with the potential for a broader but orderly decline in housing values. Affordability remains a major constraint, and higher interest rates are continuing to limit borrowing capacity and lift repayment burdens, especially at the upper end of the market. At the same time, cost of living pressures, weak consumer sentiment, and the prospect of policy changes are all adding to buyer caution. Previous downturns have seen annual housing sales fall by around 25% from peak to trough, which might provide some guidance on housing turnover through this down cycle. Housing values have shown a lot more variability, with peak-to-trough declines as large as 8.2% across our combined capitals index over the past 40 years. The federal budget has added a new layer of uncertainty to the housing outlook, with changes to negative gearing and the capital gains tax concessions likely to be legislated. We are expecting to see a sharp pullback in investment activity. March quarter data was already showing investor demand easing due to cyclical factors and higher interest rates. However, investor participation was still elevated at 40% of mortgage demand. Historically, investors have focused on the established housing market. Going forward, we may see a higher proportion of investment demand in the new housing sector, but price premiums and the risk of a shallower resale market could weigh on investor appetite to buy new. Even with the mounting headwinds, there are still some important supports for the market. Housing supply remains constrained, population growth is still adding to demand, and the labor market has remained quite resilient. So while the market is clearly moving into a more subdued phase, the most likely outcome still looks like an orderly decline rather than a sharp correction or crash. Conditions are still likely to remain uneven from one city to another and across the different price points. The key things to watch from here will be the trend in inflation, interest rates, consumer confidence, and whether listing numbers continue to rise. As always, you can find regular housing updates at the Insights pages of the Cotality Australia website.